Hello and welcome to the quarterly context webinar for the first quarter of 2020. Thank you for your patience. We had some minor technical difficulties in getting started on time, but let's get going. Glad to see there are a number of people joining us today, and this presentation will be a little more dense than usual given how much has happened in the last quarter, in particular the coronavirus and related economic and market effects. You may wish also to see a recent webinar we produced focused primarily on the coronavirus and related effects in our blog at theadvisorygroup.com. So if you have any questions, please input them into the box, and we'll try to address those towards the end of the presentation if we don't during the presentation. And this quarterly context presentation is designed to provide perspective for making wise financial decisions for both clients and friends of the advisory group. As always, I want to remind people, and especially in challenging times like this, it's never more important to focus on the intersection of things that matter and things that you can control. We can't control the start of a virus. We can control how fast it spreads. We can't control directly the impact on the economy and businesses and unemployment, but we can indirectly or partially directly influence that by social distancing, controlling the virus, and flattening that curve, as we'll discuss. So it's a stressful time, and if you focus on this intersection, it can reduce your stress because there simply are some things you can't control, and focusing on what you can, and of course those things that matter, can help you gain a sense of control and reduce any anxiety that you might be experiencing. So how have markets done? A lot of red for the quarter. These numbers at the top are the quarter ending March 30th, and or for the end of March rather. And so for U.S. stock markets, down 21, international down 23, emerging markets also down 23, and real estate down 29. Bonds, while had some negative returns along the way, and that may periodically continue, had an important diversification effect for overall portfolios at 3%, with foreign bonds being closer to 0 to 1%. If we look at the year numbers, looks considerably less negative at -9 for the year for US, -15 for developed, down 18 and 23 for emerging and real estate. If we look at just the year-to-date numbers for the US, down 15. And if we do a one-year point-to-point from April 15th to April 15th, a -5% return. So that's an important reminder that sometimes the prior strength and strong markets combined with weak markets turn out to be not nearly as bad as the very short-term numbers that we're looking at above here. You can see that down here in terms of the best and worst quarter, there were a number that were worse, and we'll see a number more data on this later. But this last quarter did have a case in international, which became one of the worst quarters on record. If we look at news, I don't need to tell you what's been happening in the news, but things seem to be going along as normal for several months, and then mid-quarter, in the first quarter, all of a sudden, initial concerns about coronavirus, growing concerns in case numbers of the coronavirus, and subsequent acceleration of both market, economic, and virus concerns. Found it interesting that Brexit didn't even make it onto our news list initially, which so much talk and concern about what the implications were for that. That also happened around the end of January, and not a major impact, especially relative to what's been going on more recently. You can see here, putting this into a broader perspective, and we'll show you more charts on this as well, helps see that these dips are significant, but not uncommon in the long run, although there's certainly some unique characteristics of this downturn. If we take a look at our updated 4 bad bears chart, if we tack on the coronavirus effects so far to the global financial crisis drop and recovery, we can see that the pretty steep drop here and then a pretty steep rise over several weeks, although it's been a bumpy rise along the way. This is through the end of March. And interestingly, if we compare that to the other four worst markets for the same time period and we combine these two markets, all of a sudden on this inflation-adjusted chart, the coronavirus plus the global financial crisis looks pretty much about where the recovery period after the 70s oil and financial crisis period. So part of what's so of the illusion, so to speak, of the drop, not that the drop has not been real, but part of the illusion is keeping this in mind in context of what has been an excessively strong stock market for so many years that at some level it's bringing back to more closer to historical averages. If we draw a line from the very peak of the pre-global financial crisis, which might be unfair in the sense that the peak then might have been a point that's too high for comparison at this stage for the purpose I'm about to mention. But if we draw a line from there through yesterday's market, the average annualized return has been 7%, even after this coronavirus period. And we'll see some longer term numbers on this topic as well in a moment. So what is driving current volatility? Well, you're probably familiar with that. But one important way to think about this that's different than a lot of other markets is that a lot of the current economic weakness and therefore stock market volatility has been self-imposed. When you do a shelter in place, a stay at home, a lockdown, however you want to call it, that is like a wet blanket on the economy and has been imposed and self-placed by the different local and global governments. So the good news about that is that it can be removed. The problem is that it shouldn't really be removed, that wet blanket, until an appropriate time, and that relates to case count, testing, and other factors. So won't go into all the details here, but this will give you a sense of the combination of factors that have contributed to this downturn, but essentially it's the wet blanket effect. It's the biggest driver. One thing I will note is that for some younger people, this is the first time that they've experienced a significant drop after having most of their investment experience be a relatively low volatility, extended, longest ever bull market. So the contrast there can be a bit of a shock, and hopefully those people will use this as an opportunity to have a more balanced and realistic long-term view without becoming excessively conservative in their investment approach to the extent that it might harm their long-term possibilities. So still like this phrase here from John Hopkins, concerns and anxiety often spread faster than infections. So keep that in mind as the average investor will tend to overreact relative to what's going on, even if what's going on is significant. So we've got a few more than usual text-heavy slides here, but so much has happened. So much has happened in the last couple of months that wanted to create an outline. Won't read through all of this, but you might find this helpful as a reference in the future. But every single line here is pretty interesting, whether it's this significant drops, that 3 drops, 7% plus, that led the automatic triggers of trading halts to happen in March, and all within this 6-day period. The pandemic was declared in mid-March by the World Health Organization, and amazingly, because of the rise that followed some of the drop, the initial drop, technically that that bull market ended after an 11-year bull market. There was a rise that equated about 20%, which means it led the bear market to be the shortest bear market ever. Now, let's not plan on that being the end of things, because the market is still down. But from a technical standpoint, when it drops 20%, that's considered the end of a bull market. And when it rises 20%, it's considered to be the end of a bear market. So just from a technical standpoint, it's an interesting story. Big stimulus programs from the Fed, larger than ever, rates cut. And despite that, market still dropped in the perception that it wasn't enough. And in one case, some of those announcements were made on a Sunday, which was relatively unheard of, and I think that surprised and concerned markets, just the timing of it, doing it over the weekend. Then countries, states, and cities began lockdowns. Some still have not done that or have done it to differing degrees, and that's part of what's creating the uncertainty. And then with some improvement in numbers and some realization that maybe, possibly, the market had overshot itself. It had the market had its biggest rise since 1933, up 11%. So partly because of the hopes of stimulus programs, again, and other factors. More stimulus programs, but also record unemployment. Over 3 million claims in a week not long ago. Then that big rally that I mentioned earlier, which technically ended the bear market, but let's not count that as being over yet. Followed by a large drop, and which ended up having to be the worst quarter since the 2008 financial crisis. Oil's been up and down. Saudis and Russians have agreed to stop that oil war, which may help create a floor for prices. But demand is so low from the coronavirus stay-at-home period that prices are really hovering at low levels. You can read the news about Apple and Google teaming up to help with virus tracking. And maybe the most notable recent news that just came out today was that there are now 20 million unemployment applications in this last month. So that's pretty significant. So there have been, on the topic of government stimulation, some are calling it stimulation, some are call it rescue packages. It's been significant and it's been fast relative to the past. Really, what helped that speed was learning from the global financial crisis. A lot of those same methods have been applied, plus new and creative ones. But that is helping to stabilize markets, even if they remain volatile. But in the trillions of dollars in terms of funding, backstopping, market stabilization, and other effects. And you can see an even longer list if you go to this website here that's produced by the Fed. Where do things stand now? Well, if we look at what is approximately the peak through the bottom, you can see pretty steep numbers here, one of the faster declines ever. markets down 32 to 34%. Even bonds took a haircut for a little while, given the speed and concerns about, more broadly speaking. If we look at that through yesterday, not quite as bad, still significant, but material bump up, being down closer to 20, with bonds being positive over that time period. If we look at diversified stock bond mixes and see the benefits of diversification relative to 100% stock exposure, where a 25% stock and 75% bond mix would have been down 10% from peak to trough, and down just 4.5% through yesterday. Similarly, you can see for the different mixes, maybe the most quote-unquote traditional balanced mix, down 21 peak to trough, and down 12 through yesterday. So some recovery already. Wouldn't get too excited about that, because there is still the possibility of significant volatility in the future, depending on a number of factors that we'll cover in a little bit. And for those that are on the younger end and may have more aggressive, higher stock allocations, which may still be appropriate for you, remember that as you're in accumulation phase and saving for the future, you're buying in at lower prices, and that can help magnify your wealth in the long run. Another factor to keep in mind, hinted at with the four bad bears chart earlier, is the mental tendency of people to measure everything relative to the most recent high water mark, or the most recent high record return. But sometimes those high or record returns are overshooting on the upside, so it isn't necessarily the most appropriate or reasonable place to compare a drop. So to help put that in perspective, if you add the peak to trough market as a simulation, or add, in fact, more specifically, even bigger numbers, and tack those on to the 11-year bull market, you would still have significantly positive average annualized returns over that 11-year period. And this, you could think about these negative returns being tacked on as the current returns, if it were through today or in the future, or through the full next year. So if it were on a full 12-year basis, if this ended up being the year return, which is unlikely, although some things are possible, but unlikely, this would still be the average return over that 12-year period. So for people who are in organizations and foundations and endowments and retirement plans, and individuals who are doing planning, these numbers are still ahead of the game for most people, given that the projected 10-year return for a 100% stock portfolio, or for the portion of the portfolio that's 100% stocked, has been 7%. So that perspective is hopefully very valuable in terms of your long-term planning and patience and comfort level. On that similar note, the 10-year projections of 7% are lower than the average return going back to 1926, partly because there are projected reductions in growth without having a clear next major productivity enhancement on the horizon. In the past, there was the Industrial Revolution and the PC revolution, and what's discussed now is the possibility of artificial intelligence being the next major productivity wave, but that hasn't really taken full effect. And there are also questions about that in terms of whether or not that will create more job losses than gains. But anyway, this is some long-term perspective to keep in mind. and on an inflation adjusted basis, because inflation in a lower growth period, it tends to be lower, the net difference between, or the adjusted or after inflation returns are actually a little bit closer to each other than the nominal or pre-inflation returns. Putting this into the macro perspective, going back, it's a chart you have seen before, but we'll show it again given the changes. The number of returns that are in the -10 to -20% range for a full year are significant. Not uncommon to have that periodically over time. We don't know where this year will end up, but there is a very distinct possibility that it could be negative and significantly negative. There's also the possibility that there could be, as some economists are projecting, the beginning of more material recovery starting in the third quarter. But there's a lot of factors that they acknowledge and caveats that will impact that. But maybe the most important element of this chart here is to note that the last 10 and 5-year periods have significantly higher than long-term average returns. And so some of what's happening now, even if it weren't for the coronavirus and if it were some other reason, would be bringing us back a little bit more towards normal averages. So it's important, as we've talked about for a number of years, not to get too excited when the returns are unusually strong, because there's usually a weaker period that follows that, and that's happening now, even though it's happening for an unusual reason. So where does the coronavirus fit into the perspective of worst days, months, and quarters? Ranks pretty high in terms of because of the steepness and the speed of the decline. Some of the worst days fit right in here. Second and third worst days, but nowhere near the worst day in 1987. So 3 makes it 3 of the top 15 on this day chart. The months, just 1 top 15, making it into the top 4, and just 1 in the top 3 quarters or 3 months in terms of how this last quarter compares. So that gives you some broader context that what's happening now, while uncomfortable, is not entirely abnormal and can be a natural part of the longer-term process and the risk that is required in some cases to benefit from the long-term benefits of having stock exposure. There is a short-term price to pay sometimes to get the long-term benefits of investing, particularly in stocks. So it's a great reminder of that. Similarly, to some degree, you can see here that kind of a pattern of bull markets and bear markets and how long they lasted. And the bull markets, you can see, tend to last much longer than the bear markets, but the bear markets tend to happen pretty steep and pretty quickly sometimes. And then when they do have a recovery, the recoveries tend to, when the recoveries really sort of take hold, even if they're bumpy initially, sometimes they have a quick snapback initially and then a more gradual recovery that varies based on the reason. But just seeing this pattern here can also be helpful. Now let's talk about the coronavirus, since this is that unusual factor, the non-economic factor that is becoming or precipitated an economic concern. A normal curve, just using illustrations here, would be fairly steep and then would naturally tail off. When there is flattening, that can reduce the steepness of the curve and also, interestingly, has the tendency to lengthen the period of cases. That's normal. The key thing about the flattening is the goal of flattening it to the point where it's below the healthcare system's capacity. So that just flattening it can reduce the number of cases, but there's still significant number of cases, but it can materially reduce the number of deaths because the number of beds, the number of ventilators, and personal protective equipment is more manageable when it's flattened sufficiently. There was some modeling done. It shows examples of the different impacts and attempts to control a virus. If there's no attempt, it looks a lot like that curve we just saw a moment ago, that tends to have a steep peak and then a more rapid drop-off. An attempted sort of forced quarantine has a better impact, but there tends to be a period where if you're primarily focused on quarantining those that have clear cases, then that tends to seep out back out into the community and can lead to another rise. Whereas social distancing, even of people who don't have cases, that helps reduce the exposure to non-symptomatic carriers, it tends to be the most effective. And that seems to be playing out in a lot of countries, counties, states, and cities around the world now, as we see, in fact, different curve. Depending on where you look, they tend to look a little bit like one of these, depending on how seriously they've taken the distancing measures. So let's take a look at a chart of a past virus, one that was in the early 2000s, the SARS breakout. And part of the reason we chose this was that technically COVID is also a SARS, and some scientists have been calling it the SARS-2 in terms of this new coronavirus. If you look at the shape here, there's a period where there's just barely percolating, and then it tends to catch fire, so to speak, can have an initial burst that may get some control. Maybe people get a little overconfident in terms of where the virus is, and then it really tends to head towards its peak period. And then once it really hits that critical mass, then it starts to trail off as herd immunity increases. Investors tend to only see this bumpy and increasingly uncertain rise and the disappointments after believing it was trailing off, and they tend to then overreact in the markets, and the markets tend to bottom out before the true sort of peaking of the virus. And if we call that a corner, investors just simply can't see around that corner. They tend to wait until there's news and tend to overreact until there's some more significant news to come out. So in the SARS case of early 2000s, that was around 5 to 6 months to the peak, and the market bottomed out before that around 4 months. Currently, this new SARS or coronavirus is at about 5 months, and the may be flattening, although it's too soon to tell. And the market bottom of mid-March was at around a 4-month moment. So even if the coronavirus has had a significantly higher case count globally than the SARS, there seems to be so far some pattern in terms of what's going on here. The dilemma with this, and don't put too much stock in what you're seeing in this chart here, is that there are so many factors that are different with each case, and the overall number of cases is so much larger with the coronavirus that the economic impacts of people sheltering at home and the impact on the economy and spending may last for a longer period of time and have expected to have a materially greater impact, and therefore some more extended impact on markets as well. So looking at the coronavirus case status, excuse me, in the currently, as of a couple of days ago, the 14th of April, we can see that the world, it's over 2 million cases with over 130,000 deaths. U.S., over 600,000 cases with over 28,000 deaths. And in California, just to pick a state, over 26,000 cases and just 813 deaths, partly because California has had such a strong and early, really being the earliest, having some of the earliest cities and as a state to mandate social distancing. So that is the current status, and you can see consistent with what we're hearing in the news, there is talk about maybe approaching the peak, and this could be the case. But if you recall here from the other SARS chart, there can be false peaks, so it really may be too soon to tell. And again, that's so variable and dependent on actual investor behavior and social distancing behavior. If people back off and stop distancing too soon, and if the rate of cases then increases and creates a new curve, that could change the game again. And what you'll notice is, if you look at other charts, you'll see just of the death rate, you'll see the death rate has not peaked yet because there's a lag effect. The number of cases here there's a lag effect with the death, so that the death rate tends to peak later than the case count. Here's an example of the impact of two things. California was very early in distancing and is really at the very lowest in terms of cases per capita. New York was pretty quick shortly after California in terms of adopting, although not quite as strictly initially, but has had a much more dramatic case and death count because their efforts to do distancing and other measures were offset by the having New York City, for example, being the highest population density area in the U.S. So distancing helps, but it can only do so much if you have if you're a little bit late and aren't and have such close proximity of people. How this impacts investors, you can see this shape of, this illustration of the market patterns. Oftentimes when markets are bumpy, we discuss this in terms of sort of intrinsic or internal economic factors, such as the global financial crisis that was primarily or heavily both a banking and real estate structural problem. In this case, it's the coronavirus, but still some of the patterns here that we see are the same. When markets are strong, people forget that risk is a big deal, and then risk happens for one reason or another. People get nervous, something we call a buyer strike, which is just that if there are enough people who just stop buying, even if they aren't selling, then anybody who does want to sell doesn't have a buyer, and since the market's an auction, that can accelerate the steepness of the curve, and that is to a great degree what happened in this very steep coronavirus drop. Then when things pick up, people are nervous, wondering, waiting, sometimes when to get back in if they panicked, and oftentimes find themselves missing the recovery, and that does a lot of economic damage. Of course, our clients don't do this because of their own investment sophistication and guidance from the advisory group, but there are quite a few average people, especially those in 401k plans with less experience, plan participants, that is, who don't have the same level of guidance and experience and financial literacy. So another text-heavy slide. We think about that coronavirus curve. There are a number of things that make it that looking around the corner less clear in this case than past cases. The corner is never really clear until it really happens, and you don't know that until sometimes several months later. But let's take a look at some of the factors that might cause this to stretch out and be a little deeper and wider in terms of economic and stock market impact in the current environment. So one factor is whether or not this current peak is a false peak. Will there be second waves? And there's a lot of talk of that possibility. Even if they're not as deep, it could be a 1-2 punch over the course of a number of months to the economy, and then markets will react accordingly. If the summer effect does not happen, and if this virus is more resilient and effective in its spread, that could push it through the summer and into the next winter, and there could be a bounce back in virus cases then. Let's hope that's not the case. There are also areas where the virus hasn't even hit its peak yet, and many of those, or some of those, are smaller economic engines, so may not have as big an effect on the economy, but that cumulatively could be a material issue. One thing that's been interesting is that economists are now realizing that the lack of savings of the average person, not having sick leave and health insurance, isn't just a personal issue. It actually is now being identified as an economic risk. If people don't have any kind of backstop or structure and find themselves suddenly without money for food or being able to pay for rent, that means there's zero spending, and that has a significant impact on the economy and therefore stock prices. So something to ponder, and that policymakers may ponder in the future, depending on the degree to which they want to safeguard against this type of problem in the future. In fact, Ben Bernanke, just a few days ago, heard a conversation with this previous chair of the Fed, said that not to be shocked by what should be pretty dramatic looking GDP numbers. Numbers that come out could be relative to the numbers in the last couple of years of 2 to 3% growth, could be negative 30%. But that's because it would be on an annualized basis. And if there's a quarter, for example, that has a 7% GDP drop in one quarter, the annualized number would be closer to 30%. So, but the comment was that this is a structurally different environment than the Great Depression, even if those numbers look like Great Depression numbers. That said, Bernanke also mentioned that if this economic contraction lasts more than a few quarters, that could lead to more permanent layoffs, jobs that simply just don't come back, which would extend and deepen a recession and make for a slower recovery. So, and there are also a number of economists who've said, when people are worried about the discussion about reopening the economy now versus, or soon, versus extending the lockdown, more economists believe that there's a long-term and medium-term benefit to an extended lockdown, even if it creates a little more short-term pain for the economy. So that's something to keep in mind. So that, the shape of the recession that we're almost certainly entering, technically the recessions are counted a certain way, and so it's too soon to know, but it's pretty clear that this is going to be considered a recession. It really depends on the health response, the public health, the response from the government, from social distancing is the single most important driver of how this takes shape in terms of the economy and the market. Some talk of, similarly from the IMF, of this recession being the worst since the Great Depression. Now, how long that will last and the degree to that will be the case is to be determined. But some are expecting improvement in the second half of 2020 and more significant improvement in 2021, but could take time, and again depends on the factors we've just discussed. What some of the people are reminding, and economists are regular to remind people, is that one really good news element is that the banking system is strong, unlike the global financial crisis. So the infrastructure, thanks to the response to the global financial crisis, is a much stronger foundation to be able to weather this storm and to respond to it. whereas the global financial crisis was due to essentially a lack of system or a failing system. What you can take a peek at this later. Essentially, default rates projections are increasing significantly because of all of the above. So what's next? What will this recovery look like when it happens? Will it be U, W, L-shaped, or pan-shaped? One thing we can imagine is something that's pan-shaped, where this unusually steep drop, steeper than the global financial crisis drop, and then it bounces around for a while until there's really clear picture of whether or not there's a second wave of coronavirus after the summer or not. It could be even bumpier through the bottom of the pan, and then some initial steeper rise followed by more gradual recovery, which is typical. The typical recovery would be more V-shaped, steep drop, a more significant recovery, and then a gradual. But because of the nature of the the coronavirus, rather, we believe it's a little more likely to have something that's somewhat pan-shaped. The question is, how wide will the pan be? We've already talked about a lot of these drivers of the scenarios, so we won't go into that again, but you'll notice that the majority of them relate to and are essentially driven by the healthcare response and the social distancing response. And testing is a key element to that as well. Again, what's next? Flattening the curve buys time for some of these things to save lives and to have government stimulus take effect before the curve gets too steep. And in all scenarios, there are benefits that will happen over time, whether it's herd immunity. You can benefit from rebalancing in terms of your portfolio, which has been done for most clients and was done near the bottom of the market. So clients have already benefited economically to some degree, even if it doesn't seem like it yet. These are helpful elements to remember going through a crisis period. So there are also other opportunities during a crisis. And crisis opportunities really happen before the crisis, not just after. Before the crisis is appropriate planning, whether you're an individual, a foundation, endowment, retirement plan, is structuring things in a way that it provides appropriate levels of risk return given the goals, given the long-term goals, the risk controls, the spending policy, personal spending plans, and so forth. And there's also something that we sometimes call life rebalancing. And that could be for a foundation, endowment, retirement plan, or an individual. If after a strong market you're ahead of the game, some clients have then pared back on the risk of their portfolios because they can achieve their goals with less risk. A number of clients did that in the last several years, and that reduced their downside during this crisis. Now, once you're in the crisis, there are a bunch of things that can be done and are being done if you're a client to benefit from that. One is the simple idea of taking this as an opportunity to practice the strategy of active patience. That really is a strategy, because overreacting and becoming an emotional investor is one of the only assured ways to do real economic damage and permanent economic damage. Rebalancing, as we mentioned earlier, tax loss harvesting for taxable clients, estate planning and gifting when with a lower tax impact, with lower values, when valuations are lower, portfolio restructuring. If there's low basis stock, that can create opportunities to diversify with less of a tax impact for those that are taxable. And some taxable investors, by the way, what could be personal, or it could be a non-qualified retirement plan that is actually taxable to the company. So those that have plans like that, where the tax liability stays on the company's books, this can be a great opportunity to restructure, and if the plan was created without a tax-efficient strategy, this could be a good time to convert it into a tax-efficient strategy. There are rule changes and opportunities that are happening, refinancing mortgages at lower rates, advisor fees such as ours, getting a built-in discount because the market lowers our values are lower. There's programs, as we've mentioned in our blog posts, from the SBA in terms of crisis funding and emergency funding for some businesses that have that need, tax deferrals, et cetera, et cetera. So hopefully this gets you, an occasional crisis can actually provide an opportunity to improve long-term wealth and outcomes. So that is the core part of our presentation for today. Hopefully that's been helpful. We will also now jump, for those that want to look at some of the additional details, we're going to quickly whip through a few additional slides and then take some questions. But first, so let's get into some of the detailed elements. The last presentation, or quarterly context presentation, we showed this chart with the blue dot. Now we can see that we're clearly in contraction. So that we've already been in the late stages of an economic cycle and entering the contraction period. The question is how deep and how long that will last. Volatility has shot up higher than the global financial crisis period because of the steepness and speed of the drop. If you compare that versus the tech bubble looking farther back, also significantly higher. In terms of some of the economic details, unemployment numbers aren't really all showing up here. That is going to start dropping off pretty steeply with that big jump in unemployment claims, and wage growth will maybe have a similar effect. Consumer sentiment has started to drop off materially, not surprisingly. The price of oil has fallen through the floor with, at one point, up to a 67% drop in crude prices. So those are some of the high-level metrics there. Over time, it will be, you'll see this this adjusted projection given the Fed stimulus programs, that the deficit is likely to balloon. Bernanke, ex-Fed Chairman Bernanke, recently said that he's not especially concerned about this highest ever $6 trillion deficit projection, given that a lot of that will naturally roll off the books and are self-terminating designs. But still, that is a pretty heavy burden to weigh and can have an impact on the economy in the future. We don't have updated, given that we did this presentation early in the quarter, we didn't have all the quality rankings to give a sense of that, but what we have seen on a more specific basis is that higher quality stocks have, as is sometimes the case in a steep drop, sometimes the baby gets thrown out with the bathwater and everything drops, and then once things settle out a little bit, quality starts to shine. So that's likely to be, and is what we're seeing so far, both the baby out with the bathwater and some initial shining as well. You can see cash flows out of mutual funds, or in the mutual fund, different mutual fund sectors, negative cash flows out of stocks, so some investor panicking there, with a big amount going into bonds, and also a sizable chunk going into cash. So not a good sign from the standpoint of emotional investors who will regret not staying the course once there is a recovery. The yield curve, well, less to talk about here. The inverted curve of a few quarters ago was predicting some kind of concern about the future. While that concern, even though it was for a different reason or surprise reason, has happened, rates have really been pushed down. The Fed pushing rates into the 0 to 0.25% range, which really reinforces the capital market projections we began to discuss in the last quarter with you about the lowered expectation for bond returns. That will then therefore lower overall portfolio expectations in a bit. Here's an illustration of sort of the risk profile of different segments of the bond market. You can see your U.S. Treasuries are the most stable and predictable, and then an array of differences with higher yield and corporate bonds stretching and being pushed out a little bit more in terms of cash flow uncertainty as consumers spend less and revenue drops. Their ability to fund or service their debt comes into question, hence the discussion earlier about the higher implied default rates. It was notable, although I didn't clarify this in that earlier slide, that the default rates are jumping more in the investment grade space than they are in the high yield space relative to 2008, even though both our default rates are projected to be high. The relative difference was higher, higher for what would normally be considered more the change, the rate of change, so to speak, is expected to be higher in the sort of investment grade corporate bonds relative to high yield. We would encourage you to take a peek at our blog. We've published a number of elements regarding the coronavirus environment, regarding stimulus programs, some of which, since many of our clients are business owners and may be able to benefit. There's some question as to news came out just today, for example, regarding the Payroll Protection Act, that those funds have now been exhausted. It's not clear who will be getting those funds and where people are in line. If you haven't heard back about it yet, if you applied, and there's a new $2.3 trillion stimulus and bond backing program that is supposed to come out, but the company-related sort of rescue packages and forgivable loan funding is going to be focused this time not on the same set of small businesses, but more on mid-sized businesses. So if you are a mid-sized business and didn't qualify for the PPP, keep an eye out, because you will want to get your application in early if it's appropriate for you to apply. So you want to give also a special thank you to all of the people out there, some of whom are family members of yours, and in some cases may be you, that are medical workers, people who are helping the critical infrastructure engine stay in place. We have such admiration for those of you and are so appreciative of your help to help everyone stay safe and fed. That becomes the base for the starting point for the recovery whenever that really starts to take hold. So thank you for that. And thank you for your time today. We will now take some questions. All the best and stay safe.